Something is building inside the COMEX silver market right now that most retail traders are going to completely miss going into this weekend. And if they miss it, they will be watching the move from the sidelines on Monday morning, wondering how they let it happen again. I already know what you're thinking. You've heard that before. Silver always looks like it's about to break out, and then it doesn't. That objection is valid, and I'm going to address it head-on using institutional data, not opinion, so stay with me. Here's what we are going to work through today. First, I'm going to show you what the Friday close price level means structurally for next week's open, and why the specific close is different from recent Fridays. Second, I'm going to walk you through what is happening inside the COMEX registered inventory right now, and why the coverage ratio is flashing a signal that professional traders watch closely. Third, I'm going to show you what the gold-silver ratio compression is telling us, and why the number we are sitting at today has historically preceded violent moves in silver, not slow grinds. Everything I am about to say is grounded in documented CME Group warehouse data, the Silver Institute's 2025 World Silver Survey, Bank of America Commodity Research, and Goldman Sachs macro notes from the past 30 days. This is not personal opinion. This is the same data flow that institutional desks are looking at right now as they position into the weekend. Let me build this from the ground up, because each layer depends on the one before it. Silver closed this week in the $73 to $74 range on COMEX front-month futures, consolidating right below the weekly VC PMI mean of $75 to $71. That price level matters. The weekly mean acts as a gravitational boundary. Price that consolidates below it for multiple sessions either compresses into a rejection that drives it lower, or it coils until a catalyst forces a violent break above it. And right now, we are sitting in that exact compression zone with the June COMEX delivery window already open. Here is where it gets critical, and this is the piece the retail crowd is not paying attention to. According to CME Group warehouse reports as of early June 2026, COMEX registered silver inventory, meaning the metal that actually carries delivery warrants and is immediately available to settle futures contracts, is sitting at approximately 76 million ounces. Now here's why that number should make every serious silver trader stop what they are doing. The Silver Institute's 2025 World Silver Survey documented that silver entered this year in its sixth consecutive annual supply deficit, 6 years of structural undersupply. And the mechanism that held that deficit together, the assumption that paper claims on silver could be settled in cash without forcing physical delivery, is now being stress tested in real time. Before we get to what that means for next week's price action, I need you to understand the coverage ratio, because nothing else I'm about to say makes structural sense without it. The coverage ratio measures what percentage of outstanding COMEX paper claims could theoretically be satisfied with registered physical inventory. When that ratio drops below 15%, traders classify it as stress territory. In January 2026, we saw a 7-day period where COMEX warehouses reported a 33 million ounce withdrawal, representing roughly 26% of registered inventory vanishing in a single week. JP Morgan issued delivery notices on 8.1 million ounces in that same period. Open interest did not collapse after those deliveries. It increased. That means more paper claims were being written on a smaller physical base. That is not a normal market condition. That is the kind of structural tension that builds quietly and then releases suddenly. Now connect that to where we are on the gold-silver ratio today. As of June 2nd, 2026, the gold-silver ratio compressed to 59:1. That is silver's third outperformance session in a 2-week span according to US Gold market data. Historically, when the ratio compresses below 60 from an elevated position, it has preceded sustained silver outperformance. The historically extreme compression level is in the 15 to 20 range. That was the ratio reading in 1980 during silver's parabolic move. We are at 59 today and declining. Bank of America Commodity Research has publicly noted that silver's dual identity as both an industrial metal and a monetary asset creates a reflexive feedback loop. Once industrial demand holds the floor and monetary demand accelerates simultaneously, the paper-to-physical tension amplifies price moves in a way that gold alone does not experience. Goldman Sachs macro notes from the first half of 2026 have consistently flagged dollar weakness and Federal Reserve policy uncertainty as the key variable for precious metals positioning. The March 2026 Fed hold, which dialed back dot plot projections to just one cut for the year, hit silver almost 20% harder than gold over a 2-session window. That is the amplification pattern that matters going into this weekend. If Friday's non-farm payroll data or any Fed speaker commentary shifts the dollar index even modestly, silver's response will be disproportionate to gold's in either direction. Which brings me to the point where I need to ask you a direct question. There are 2 kinds of people watching this video right now. The first kind sees the COMEX inventory data, reads the coverage ratio, understands the delivery pressure building in the June contract window, and already knows what to do before Monday's open. The second kind will wait until silver has already moved $5 in either direction. We'll read about it in a financial news headline 3 days later, and will tell themselves they need more confirmation. That is the fork in the road. Strong hands use the Friday close as positioning data. Weak hands use Monday's gap as a reason to chase. Which one are you? Now let me give you the two scenarios you need to hold in your head going into this weekend, because I'm not going to tell you which one plays out. The data does not resolve that yet, and anyone who tells you it does is selling certainty they do not own. Scenario 1 is the bull path. If silver holds above the $73.25 level on Friday's close, and the dollar index fails to reclaim the 104 handle going into the weekend session, the setup for Monday points toward a retest of 75.71, which is that weekly VC PMI mean we discussed. A clean break and hold above $75.71 opens a technical path toward the $78 zone. And if we get any dovish Fed commentary or a soft payroll print before the close, the move towards $78 to $80 becomes a realistic 2-week target. Blowfin research specifically identified $94 as the next major resistance gate above that, with the $120 zone reopening on a confirmed break. Citigroup, in their January 2026 research, targeted $100 to $110 for the second half of this year. That path depends on physical delivery pressure intensifying in the June COMEX contract and the dollar staying soft. Scenario 2 is the bear path. If Friday's close fails to hold $73 and Treasury yields stay above 4% into next week, silver faces a test of the 50-day exponential moving average at approximately $78 on the way down. And if that level breaks without buyers stepping in, the Blowfin analysis points toward a test of the 200-day moving average at $63. That scenario aligns with what happened in March 2026, when the hawkish Fed hold dropped silver nearly 20% in 2 sessions. While gold fell only 6%, silver amplifies in both directions. That is not a warning. That is the mechanism. Now let me be honest with you about the real risks here, because this is where credibility either holds or breaks. Timing risk is real. The structural supply deficit in silver has been documented for 6 consecutive years by the Silver Institute, and silver is not at $200 yet. Structural arguments can be right and early at the same time. If the Fed surprises markets with another hawkish hold in the coming weeks, silver will take the largest hit of any precious metal. The paper-to-physical tension in the COMEX system is real and documented, but most COMEX contracts settle in cash, not physical metal, and that can continue longer than any thesis anticipates. China restricting refined silver exports tightens the global supply chain, but that is a slow-moving pressure, not an overnight catalyst. The volatility window around the Friday close is real, but it cuts both ways. A miss in either direction before the weekend creates a gap that retail traders cannot react to until Monday's open. Know your position size going into this weekend. Know your level. The Friday close tonight on COMEX silver futures is not just a price. It is a signal. It is telling institutional desks whether the compression below 75.71 is building energy for a breakout or setting up a rejection that sends the June contract back toward the lower band. The delivery data, the inventory coverage ratio, the gold-silver ratio at 59 and compressing, the 6th consecutive annual supply deficit, and the Fed policy uncertainty, all of it converges into a single Friday closing print. And when you wake up Monday morning and see the first tick of the new week, the question is not going to be what happened. The question is going to be whether you already knew what to watch for, or whether this is the moment you realize you should have been watching Aurelius Metals before the move, not after it. Because here's what I still have not told you: the specific COMEX delivery notice data from this week's final session, and what it suggests about who is actually taking physical silver off the table before the weekend, and what that tells us about where the really large hands are positioned right now for next week. That is the number that changes everything. And you are going to want to be here when we cover it.